Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 20th day of August 2019. Before I talk about today's show, let me remind you I do publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that letter, which I think you should do because it's an exciting time in the junior gold mining space. Go to miningstocks.com, and sign up for the letter, or you can call us here in New York at 718-457-1426, 718-457-1426. Also like to encourage you to consider subscribing to Chen Lin's letter, What is Chen Buying, What is Chen Selling? Go to chenpicks.com. Also, want to thank you for listening to this show, making it one of the more popular Voice America business channel shows. And I do want to invite you to continue sending along your comments to questionsfortaylor@gmail.com, questions number 4, taylor@gmail.com. Also want to thank our sponsors for making this show economically viable. Sponsors for today's show, Klondike Gold, Novo Resources, Radisson Mining Resources, and Great Bear Resources. I've titled today's show, Frank Holmes on Gold and Markets in General. Forced by the U.S. to abandon the gold-backed monetary system after August 15, 1971, the world has embarked 100% on the use of fantasy money created out of thin air rather than money with intrinsic value. The dollar, which is dictated by law, not chosen by markets, is money backed not by assets like gold or silver, but money that is manufactured by debt and hence has no intrinsic value. When Nixon separated the dollar from gold and ushered in a floating rate global monetary system backed by debt, the dollar retained its value not because it had any intrinsic value, but because the U.S. used its military superiority to essentially force the world to accept the dollar for commerce, most notably underpinned by an agreement with the Saudis to require all global oil purchases made in dollars. That's how the U.S. dollar became the world's reserve currency, which meant we in the U.S. didn't have to produce much of anything to buy production from developing nations. We could simply print money to get what we wanted, and so we did. Now it seems other countries are not so sure they want to continue using dollars for their trade or to invest in a country that uses the proceeds of treasury bonds to expand its military and force those same nations to submit to Anglo-American empire desires. Not only that, but with so much money printed over the decades, it has served to destroy capitalism by denying price discovery of capital. And so the U.S. uses its resources to wage war everywhere, while a cancer within the global market system spreads, leading to what many believe will be a global contraction of wealth in the years to come. One thing we do know is that unlike fiat money, gold retains its purchasing power, as James Turk pointed out so well in last week's show. One investment pro who knows as much about the gold markets as anyone I know is Frank Holmes, the CEO, Chief Investment Officer of U.S. Global Funds. Frank will be with me in the second half of today's hour to give an outlook on gold and other markets during this, as I say, during the second part of today's show. And he'll also talk about the gold ETF that is under the U.S. Global Funds umbrella. It is a fund that is really outperforming its peers. So we want to find out from Frank how he has managed to accomplish that. Right after our first commercial break, Eric Coffin, the co-founder of the Metals Investor Forum and author of an excellent newsletter called The Hard Rock Analyst, will be with me to give his views on the markets. And he will talk about a couple of the stocks he is most excited about as this new bull market really starts to get underway. Eric always has great insights into the markets in general as well. And one of his favorites, however, among the gold stocks is Great Bear Resources, a company that is a sponsor of this show. It's also one of my favorites, so I'm really looking forward to what Eric has to say about Great Bear. But right now, I'm happy to tell you that I have Michael Oliver with us to help us see where things are going and find out what's on his mind today. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
Always good to have you with me. Now, we have clearly seen gold in a very convincing breakout mode over the past couple of months. What, in your view, is driving gold, and to what heights do you think it might go as measured in U.S. dollars?
Well, gee, that last question, I don't know. Taking out the all-time highs is 1920, 2011 highs, likely. Right now, this particular surge that we're in, I think, is likely to reach 1700 area. There might be some congestion in between, minor correction, but I don't see anything of a major correction, which so many people are looking for constantly over the last few months. I'm sure they're frustrated. Every time they get a dip, it stops about 2 days later and goes back up. But as far as the ultimate, I don't know. That is, I can't technically determine that, except to say that I do think we're in the final drama of market manipulation and the things you've just defined. In other words, the errors in calculation that so many people have made because of the distortions of the underlying money unit, but because of distortions in the cost of money, and so forth, and over such a long period of time now, 10 years solid of this stuff. So the distortions that are millions, individuals make mistakes, corporations make mistakes, governments, et cetera. So many mistakes have been piled up based on these false metrics that it's hard to tell all the ramifications, except to know that they're large.
Yeah.
We've never had such a thing. So when it unleashes to then say, well, where's gold going to go in that process? I can say up and big, but I can't tell, what is a number that we're headed for. I can't tell.
Yeah, of course, understandably, and of course we don't really know, with the dollar not having any value, or certainly not any consistent value, then, that's the unknown as well. It's like changing the length of a yardstick and then asking what is a yard.
Yep.
But Michael, one of the things that I'm hearing from a lot of my friends, people that have been watching markets for a while, they all seem to be kind of fearful that we're heading into, that we'll have another kind of 2008, 2009, and then a deflationary collapse of commodities and just a deflationary environment in general. But actually, you seem to be holding out the view that we could be looking at something more akin to the late 1970s up to 1980, and sort of do I understand, maybe you think we could be headed for a deflationary sort of a situation like the 70s where we had both a lot of inflation and a lot of unemployment.
Right. It's what they call the word stagflation came about.
Stagflation, right. Thank you.
It was actually a depression, but we'll get away from that. Anyway, so the stock market was a wasteland for a decade. You put money in the stock market, was up and down, but didn't go anywhere for 10 years. But meanwhile, in the mid to late 70s, commodities, which had already been trashed, were laying at levels that were basically what we call theoretical zero. In other words, commodities don't go to zero. Company stocks can go to zero. But commodities can't. And there's certain times in history where they get bashed so bad, so low, that they demonstrate that, one, I'm not going any lower. Okay, and I think that's basically where commodities are now. In 2011 and early 2012, MSA turned major bearish on gold, emerging markets, and commodities in general, CRB index, or the Bloomberg Commodity Indexes, which is the one we watch now. The Bloomberg Commodity Index back then in 2011 was had a peak above 170. We got bearish in the low 140s in December of 2011. They collapsed to a low in 2016, coincident with gold's drop, of 72. So they were cut in half from the 2011 high to the 2016 low. Then the Bloomberg Commodity Index rallied from the low 70s up into the low 90s, a 27% rally. In 2018 was its rally high. And now, since then, it's rolled back over, and it's about 77 right now. It's still off of its 2016 low. But when you look at a price chart of Bloomberg, it's 3.5 years, almost 4 years now, of sideways. It's not going down. It collapsed. I mean, what do you want? Did it go to zero? It's not going to go to zero. Same if you look at a chart of corn, wheat, soybeans, sugar. They made lows. They had rallies to varying extents, and then they flop back down. But they're not making new lows. They're in a range. So the definition of what they're in technically is sideways, horizontal markets. They're not bear. They're not bull. We did have some good, strong moves out of oil and copper during that period. They both peaked in 2018 after very strong percent moves and then flopped back down hard. But we think that the commodity complex as a whole, we've made some fumbles on calling the grains, for example. They've had some up moves and they were false. But when they fell back, they didn't go to new lows. They just went sideways again. I think as a concert, the commodity complex will move in unison. But I think that's likely to occur when the stock market does get whacked hard, because at that point, first off, there's some technical linkage right now between the Bloomberg Commodity Index and, let's say, the S&P. It's hard to detect, but, as the S&P weakened recently, so did the Bloomberg, et cetera, and oil drops with the stock market, rallies with the stock market. But we think a separation is going to occur, and we think it started in the form of stock market peaking and commodities bottoming. When the central banks go nutso on the next stock market drop, and they will definitely go nutso, they've already said so, I think that money's going to flow into the commodity complex simply because it ain't going down anymore. And people will perceive that. Rational minds will look at the charts and say, these aren't bear markets, these are sideways.
Yeah.
They don't want to go any lower.
Well, Michael, let me ask you this then. You've been a short-term bull on the Treasury markets, the T-bond you watch closely. You've been, as I understand it, a long-term bear on those same markets. Do you think then that the turn downward in the Treasury markets might occur along with the realization that we are in an inflationary environment?
I suspect that the T-bond downturn, a rise in yields, and I don't think that drop in yields right now is over with. It has nothing to do with the Fed. It has to do with market forces. I think they're going to continue to drop in yield as the market tops and goes down, stock market. I think once you get your first big whoosh down in the stock market, at that point you're likely to get a spike up, flight to quality, flight to safety, in the T-bonds. At that point I'd get very suspicious about continued drop in rates, continued rise in the T-bond market in price. Because I think at that point some emotion will come into the T-bonds that is more or less flushed out the money that it's going to get from those who are fleeing the stock market. And at that point, that's where I'm looking for the T-bonds to probably crest and head back down in price, meaning rise in yields. And that's when you get your real nightmare. You have a weak stock market and you have rising rates as well. Yeah. I think during that period of time, we're likely to have the commodity boom like we had in the late 1970s, which, by the way, was led about by a year, the gold market.
Right.
And so I think that's where we are.
All right. All right, very good. I would just mention, you said, I think when you first started talking about the 70s, it was a depression, and I know James Dines talked about how if you really factored in the inflation rate during the 1970s, the equity market actually performed as badly or close to as badly as it did in the 1930s in the Great Depression. So I thought that was really interesting. You can have rising prices, but if your currency is losing value all the time, those rising prices don't do you much good. Michael, thank you so much for being with us. Your views are very much appreciated. Your thoughtful views, whether people want to hear it or not, I'm thankful to you for telling it like it is, or as you see it, and as your very objective models suggest it is. So thank you so much for being with us.